Hey, what's up, you guys? Welcome back to On a Real Note. My name is Xochith.
I'm Alisha, and we have a very special guest with us today, Miss Stephanie Burgos Todd.
Hey, everybody.
All right, so we're super excited. Stephanie is actually a regional vice president in this company, one of our newest in the office, so it's a big deal that she's here. So
well, thank you so much, you guys. I'm honored and excited to be on the podcast. I was like, wow, I'm like moving up in life. No podcast today.
No, we have a little bit of a different thing going on for you guys today. We wanted to do a little bit more of a panel style, right? So we have some questions, just really digging deep when it comes to like life insurance and kind of explaining the ins and outs of that we think that you guys would typically kind of have to ask. Now, one of the questions that we have here is, do I really get my money back from my life insurance? Right? So, because, there's different types of life insurance, and I feel like there's a lot of misunderstanding when it comes to how things work, especially right now. There's a lot of new terms being thrown around, right? Like with infinite banking and stuff like that is very popular. And of course, a lot of people are trying to use life insurance right now as a means to
invest.
Yes, definitely, because that's how a lot of people are selling it. But what I want to say, you guys, is you definitely have to be very careful when it comes to what you're kind of hearing specifically, like on TikTok and stuff like that. You want to make sure that you get your information from a reliable source and people that are actually in the field, in the industry, right? So Miss Stephanie, being like the expert in all things related to life insurance, right? I kind of want to pick your brain. There's different terms that are being thrown around, right? Like infinite banking. I'm sure you guys have kind of seen that or heard more information about that. One of the typical ones, Steph, that people are hearing out there is cash value. Now, what really is cash value?
That's a good question. So what it really comes down to is that life insurance can be broken up into two separate categories, right? There's cash value, which means there's a savings component that goes with the life insurance, and then there's term, which means just like, think of your car insurance, think of your health insurance, where you get it for a set amount of time. Typically, health insurance is for a year. Typically, car insurance is 6 months to a year, and then at the end you have to renew it, right? So your life insurance can be the same way, although the terms will vary, where it's 10, 20, 30, or plus years, that it stays the same. So that's going to be the biggest difference, is that whether it's a cash value insurance, which means it has a life insurance with a savings, or a term, which typically does not have a savings, right? Which is where we talk about you want to get term, because it's typically the least expensive of what's out there in the market, and you want to invest the difference, right? But when it comes on the cash value side, it's going to vary, and that's where people get confused because they think it's all the same. But you have universal, typically it's a universal life insurance with, different flavorings, and then a whole life with, again, different flavorings. But typically those are the only life insurances that exist. It just depends on the style, the flavor that the company that you're with what extra accessories or details it's going to have. Yeah.
Okay. So, and then you said that with term, it's typically the one that's going to be more economical for a family.
Yeah.
Right? So, outside of that, what is the benefit of getting a term policy as opposed to, I've been hearing a lot about what what clients want is they want something where, like, I want money back. I want to go ahead and make sure, like, because the mindset that I've come across is, okay, the life insurance isn't going to benefit me specifically. So what benefit do I get? Besides, because I've seen people that, like, I want to pull money out of it and go ahead and make more money and be able to put it down on a car. That's specifically what I've been hearing a lot.
Okay.
Right? So what would you kind of say for somebody that's looking into something like that?
Well, it all comes down to what is the goal, what is the purpose, right? If your goal is, I want to have money to put a down payment on a house, to get something in the future, then it's not a life insurance you're looking for. You're looking for some sort of investment or savings account. It serves a completely different purpose. Now, if you're going to get a life insurance, the whole purpose of a life insurance is to make sure that if anything happens to you, your family is whole again, at least financially. Or that's what the whole concept of indemnity comes in with life insurance. And it's to make you complete again. So what I always ask people is, okay, well, when it comes to insurance, if you have your car and you never get into a car accident, do you expect to get money back from that? And most people say, well, no. Okay, well, if you have health insurance and you never go to the doctor because, like every good Latino, they never want to go to find out what's wrong with them, right? So if you never go to the doctor, do you get money back? Well, no, right? So why would your life insurance be any different? So it really just comes down to, well, okay, what is the purpose and what is the goal? What are you really trying to do? And then we work backwards. Because if it's like, well, my goal is to buy a home, then as someone that's in the financial realm, I would never say life insurance with a cash value. Absolutely.
Right.
Then it's like, okay, well, there's other avenues that are better that we can use to really attain your goal faster. Mm-hmm. That makes a big difference.
That makes sense, because it sounds like, so specifically because what we deal with our company is term, right? So because for us the main focus, like the foundation of somebody's financial plan is going to be that life insurance, right? That policy that can make sure that their family, if anything happens, is okay, right? So what's going on, I think, is a lot of people are seeking out a life insurance plan, but they don't really want a life insurance plan.
Absolutely. And a lot of it's also just reframing. It's reframing the purpose, because, well, they say, well, this is something I'm not going to benefit from. And it's true. It's not meant for you.
Right.
You are not the true client. It's going to be your family. So if you say, okay, well, when you pass away, because unfortunately it's going to happen to all of us, we don't know when, but one of the things I have noticed, and I tell a lot of my new agents or clients, is that in a post-COVID world, is that more people, in a post-COVID world, more people are open to that conversation, right? Where they say, you know what, I saw someone, I heard of someone, my Instagram feed or my Facebook feed or whatever, I saw the GoFundMes, I saw this and I saw that. So really what it comes down to is, okay, let's reframe what your thought is of what life insurance is. Is it to be here to protect your family? Is it to make sure that even though there's an emotional burden because someone passed away, there's not a financial burden on top of that? So those are the things that we really look to, is that, okay, well, let me re-educate you on what the purpose of life insurance is, so you understand really what it's for. And I think that's the biggest thing that we're coming across in our industry, and especially now with TikTok and social media starting to talk about it, is that there's a big misconception, and we need to actually have more literacy in exactly what it is a life insurance is for, the purpose it's really for. It's not to become your own bank, because you mentioned infinite banking earlier. And so what a lot of people don't realize is that when it comes to all of those things, they're just gimmicks to get you to be a client, honestly, and don't get me started on infinite banking, because it's a whole thing where people honestly are being lied to, because they think, okay, well, if I get this $1 million policy, if I go up to Xochitth and I say, okay, Xochitth, do you want to become your own bank? That sounds pretty cool, right? Xochitth, would you agree? That's like, oh yeah, I really want to do that.
Yeah.
So now I say, okay, I'm going to sell you this $1 million policy, right? And what this $1 million policy is, you can pull from it whenever you want. Then you can get a loan for yourself, right? And the best part is that it's tax-free, right? But let me ask you this: if you get a credit card and you use the credit card, does the government tax you on the money you borrow on the credit card, or Fourplex, or ForPay? What is it?
QuadPay.
QuadPay, right?
Now known as Zip.
If you'd like to sponsor us, please, we'd appreciate it. But when you use those things, you do not get taxed for borrowing that money.
Yeah.
So it doesn't make any sense that if you're going to take a loan out of your own money, that they would tax you, because again, that's just not how the system works. So that's they reiterate that, you're not going to get taxed, if it's a benefit, but it's just how loans work, right? So when it comes to infinite banking, the whole ideology is that, hey, you get to get this big life insurance policy, you're going to become your own bank, and then you never have to pay interest to a bank again. the misconception is if I sell you $1 million policy, you can pull from the $1 million of coverage. That's not the case at all. So I want to let the internet know you cannot borrow against the face amount. What you can borrow against is whatever's in your cash value. That's what you can borrow against. Now, when it comes to the cash value, though, they all have what's called a surrender fee. Again, that doesn't get disclosed. Okay, and what the surrender fee is, it's kind of like an ATM fee. You know how like if you go to a different, like if you Bank of America and you're out at a concert because you decided to go to Coachella. Yes, exactly. So every time you pull money out, it adds a couple bucks because that's not your bank, right? So with infinite banking and with wanting to pull your money out, well, the surrender fee is going to charge you to pull your own money out. So it might charge you, especially on $1 million policy, it might be a fee of like, I don't even know, maybe $10,000 to pull your own money out. Maybe 5, maybe 20. I don't know. Every company's different. So now, not only did you just put a bunch of money in because they told you put in 20 grand so you can pull it out, you have an immediate loss your first year. So, and no, you cannot pull in 3 months from that money. And that's the part that people, I had another client that they came up to me and they're like, no, but in like 3 months I can pull it out and like put it back. And I was like, no, if you look on the schedule, this is what you have available. And they were a little bit confused and they were like arguing with me, and I was like, look, do what you want to do. But on paper, in writing, this is what it says, that it's projected your first year, this is going to be what you have available to borrow. Not from the $1 million. Right? And like, well, that's not what they told me. I'm like, it doesn't matter what they told you. At the end, it doesn't matter what they say, it doesn't matter what I say. What matters is what's in writing. Right? And so, exactly. Right. Because the judge isn't going to, when you sign off, and let's say, and that's what happened to a lot of people in the 80s, that they signed off because they thought, back then it wasn't infinite banking. Back then it was, this is a retirement program. and it's still getting done today. But back then specifically, it was a retirement program was the gimmick. And then you had a lot of people coming up to the retirement, and they had nothing in savings. They had nothing there, and they had been putting money into these programs. Yeah. So imagine you put money into a program for 20, 30 years. You come up to start pulling money out, and there's nothing there. Or you only have a couple thousand compared to the 200, 300,000 they projected you were going to have. So how would you guys feel if that was your situation? Yeah. So that happened to hundreds of people, hundreds of thousands of people, I should say. And they sued a lot of these companies because they were misrepresented. But one of the things is that the judge will always ask you, is that your signature? You have a free look period. What you're supposed to do in that free look period is look through it and see, do you like it or not? Do you agree to all these terms or not? And mind you, most people
they don't understand it.
They don't understand it. So a lot of it is that it's in, I call it, it's just in the legalese, right, or insurance language of what these things mean. So you're trusting your agent to really be doing the most for you. Right. You're really trying to have your agent be your guide, and that's why we do what we do, right? So that's one of the biggest differences, right? Tell people, hey, you know what? As at the end of the day, it doesn't matter what I say, it doesn't matter what they say. What matters is what's in writing. And part of being in our company and in our office is that we're very education focused, right? And we really just want to do what's right. I mean, that's a slogan for our company. We do what's right, right? So it's okay, well, at the end of the day, you can, even if it was your brother, your mother, your sister that sold you the product, legally, these are how products work, right? So yeah, that's huge.
She's typing out a question. Is it used with whole life or any?
Oh, we have a question from the audience. I love this. I didn't know you guys were doing this live. That's awesome. Okay. So, whole life. Is this used only with life, whole life, or any cash value insurance? So typically what I've seen is that for infinite banking, they tend to lean more toward the whole life from the examples that I've seen. Internet world, right? So that's kind of what I've seen more. Now, either one could technically be used for that. Now, the biggest difference, and I think this is where there's a lot of confusion because people use whole life and universal life interchangeably.
Right.
Now, this is where the biggest difference happens. So, in a whole life is going to be the most expensive of any life insurance, regardless of company. Just the program itself is an expensive product. Okay, so now whole life is meant to last your whole life. Okay, so or what they project would be your whole life, right? So with a whole life, what happens is that if, let's say, your parents, that's why when your parents get it for you, like when you're like a baby, it's super inexpensive compared to when you get it as an adult. Now the way that it works out is that you're supposed to be putting money in, and the premiums or the payment and your cost of insurance does not change. Okay, that's different. That's one of the biggest differences from that to the universal. So they keep making payments until you're supposed to keep making payments until like 100, or I think for the newer generations they upped it to 125 is what I think it is, because life expectancy was supposed to go up. 125 years old. So
I don't even know. I never knew that one.
yeah, so look into it, but I think for the whole lives, because what happens is that it was usually 100. I want to say they increased it, but don't quote me on that, right? But what it was is that you would keep this life insurance until you were 100, and if you lived to 100, then you would get it would endow. And what that means is that at 100, whatever your face amount was, whether it's 50,000 or 100,000, you would get that money, or your cash value should be at that much at that point. Okay, that's how a whole life works. Now, that's just a basic whole life. Now, what happens is that a lot of the insurance companies would be like, "Don't worry, Alisha. You know what's going to happen is that you're going to have this life insurance, but after 20 years, you don't have to send payments anymore. After 30 years, it's paid off." Okay, that was the script that was being used. Now, and that's what you have: a limited pay 20-year whole life. You have a 20-year, 30-year limited pay whole life. Now, what they don't explain to the client is you can't just stop sending payments. So what happens is that if you have a whole life, and now you remember because they told you 20 years, so I'll be 65, right? So at 65, you're like, I'm done. I finished making my payments. I'm good, right? And then all of a sudden, they get a letter a couple years later saying, hey, you owe us money. You got to send payments again. They're like, but why? My agent said that after 20 years, I was fine. So what happens is that at the 20-year mark, you have to activate what's called a non-forfeiture option, right? I know it's a lot of specific language, but that's how they get you out there, So internet world, I'm giving you all the words, okay? So it's called a non-forfeiture option. And mind you, everything that I'm covering right now, you guys, it's part of the California licensing textbook. So none of this is stuff that I'm just making up or pulling from the air. It's literally what's in the book of like, this is how life insurance works for your test, okay? So you can look this up. So with a whole life insurance, you have what's called 3 non-forfeiture options. So the options are, 1, you can decide to say, hey, I don't want this anymore. Let me give it back to the life insurance company. Give me cash or whatever I've accumulated, and we're good. We're Gucci, right? The second option is, you know what? I don't want to send payments anymore, but what can we do? So they go, okay, we're going to do a reduced paid up. So maybe you had 100,000 in coverage before, but now it's like, you know what? We have to lower your coverage, but we're going to take whatever's in the cash value, because legally they can't call it a savings, right? We'll take whatever's in the cash value, and we're going to put that to make sure that it's paid off. So you don't have to send any more payments, but now your coverage goes from 100,000 to 20,000, right? And sometimes that doesn't get explained. So they still think they have 100,000, and then when they pass away, their family only gets 20,000. Okay, so option number 3. So that's option 1 is you get the cash. Option 2 is they're going to lower the coverage, but you don't have to send any more payments. Option 3 is an extended term. Okay, so the extended term means, okay, well, yeah, okay, you don't want to send payments, but you don't want to lose your coverage. So what we're gonna do is we're gonna change it basically to a term. So what that means is that, and remember, they're the ones that say term is bad. So what's gonna happen now is that we're gonna take that $10,000 that you've accumulated in your cash value, and we're gonna apply it to future payments. So this will keep you covered without you sending any more payments for another 10 years and 230 days. And that's it. Okay? But anytime you activate a non-forfeiture option, you're giving up your cash value. So you no longer have that savings, and that's specific to whole life, right? So then they're like, okay, well, now you're done. So now if you got sold this policy as a retirement program, well, now you have no retirement program, and you have less coverage, or you're limited to what you have.
Right.
To the time, I should say. Right? So those are some things that you look into. Now, everything has its place, because there's some people that say, well, I want to have a whole life. I want my policy to stay till 100. That's on you. As long as you're going in with your eyes wide open,
Right.
then you know what? If you want a whole life, get the whole life. If you want the cash value, get the cash value. Would I recommend that? Well, no, because we have a different strategy with the buy term and invest the difference, right? That we talk about and that we explain and we educate our clients with. And when you can take the money of a whole life, and you can say, hey, I can save you this money and invest it, and I can actually cover you for a little bit more or a lot more, then it's a strategy, but you're doing a whole package. Does that make sense? Which is why it's so important for everyone to get their investment license too.
Right.
Yeah.
So would you say, I've heard some, people talk about this before too, like in our company, if you're not doing the full job, right, that we specifically preach about, buying term and investing the difference, then you're not doing your due diligence, right? So that you're not fully helping the client, and if you're not doing that, then they might even be better off with the whole life if you're not investing the difference.
Really, it's true, because how can we say we're doing the right thing for the client if 30 years from now, 25 years from now, they're up in retirement age, and now when we renew, it is going to be more expensive. Now, what's wonderful specifically with our company, it does renew, you can keep it till 100. Awesome, right? But what ends up happening is that if you're not doing the full job, then the client also kind of gets a little jarred by that, because it's like, wait, so it's going to go up? Wait, because they forget, even if you cover all of these things, right? So you'd rather have it be like, well, you can renew it, or you already have 200,000 saved. You have 150,000 saved. You have $1 million that you've accumulated over your time. So guess what? You're self-insured. You don't need to get life insurance, right?
Right.
So do we have another question from the audience?
Yeah.
Ooh, okay. I like this. This is a cool setup.
So what's the difference between whole life and
IULs? Okay. Very good question. So everything we covered for whole life is any whole life, okay, guys? So now, when it comes to IULs, now I kind of want to dispel another myth, whether it's IUL, VUL, flexible premium, adjustable life, variable life, these different titles or descriptors for the life insurance, essentially they all are the same program. The only true thing that's going to change, is whether it's the I or the V in front of it, is where the actual cash value is going, okay? So when it comes to all of that, in a universal life, it is a very different program and how it works internally from the whole life. So as we're the whole life, the cost of insurance stays the same forever, blah, blah, blah. In a universal life, it actually will increase every year. So inside a universal life, you have what's called an annual renewable term. So the cost of insurance goes up every year. Now, because most insurance companies are not investment companies, right? They just they have to pay someone, or there's fees to do the money management part, and then there's the overpayment that goes into the cash value. So what happens is, over time, as the cash value grows, right, but also the cost of insurance goes up. So eventually there comes a point, and this is kind of like where they get creative, because they say, oh, your premiums never go up. Okay, premiums is the money they're collecting. Yes, it's true, the premiums never go up, but internally the cost of insurance is going up. Okay, so what ends up happening is that down the line, it could be now they're in their 60s or one time I had a client that told me it happened to their grandparent in their 70s, where they got a bill in the mail that said, well, now you have to send us $300 for your life insurance when they had been paying, I think, like $80, but the cost of insurance had been so high and they no longer had any cash value.
Yeah, so like ate it up.
Yeah, it ate it up. So that's one of the biggest differences internally. Now, some people may use the IUL in infinite banking, but typically what I've seen more is the whole life. Now, there could also be the whole, hey, you know what, we want to have this concept, this idea, oh yeah, this has a savings component, but they're going to sell you the IUL, right? Now, the whole thing with IULs that they say is like, oh, well, your money's protected because it's in an index. Now, let's talk about the savings component. So, we talked about the cost of insurance goes up, there's a savings component, so you're overfunding is their language that they use, is you're overfunding into the cash value. So now, what is the cash value in? So here's where it gets interesting. So you have fixed accounts and you have variable accounts, right? Now, when people see the IUL, they think it's safe, it's secure. So what's funny about that is that that money or that savings component goes into the general account, okay? What the general account is, it means that it's actually being reinvested back into the insurance company, okay? So the reason why there's certain guarantees and there's certain things like that is because that money goes into the company's general account and they're the ones that are ensuring we're going to at least pay you this. So it's not necessarily being invested in the market. Does that make sense?
Right.
It's being held internally, and then as profits grow for the company, then that's where they're going to make sure they have money for you. So that's the other reason why there's a cap. So there's a cap at how much you can gain, and then there's a cap that you won't lose because they're guaranteeing that, or to lose very little, right? So there's a certain range that they're given. And mind you, this is also true if it's in a index universal. The index variable. I can't speak. Index annuities, okay? So if it's an index annuity, it's the same kind of concept applies, right? But when it comes to that index, is that the money's being put in a general account, okay? So that's where that's coming from. Now, in a variable universal life, the cash value was actually being invested in the market, which is why to anybody that is going to sell that product has to have a investment license.
Right.
And that's where the client had the option to invest that part and what they wanted to invest it in. But in this day and age, we see that a lot less. Where I haven't seen any in the last 10 years, right? So IUL is what's on the rise because you don't need a investment license to sell it, right? So that's what ends up happening there. Now, anything that has a cash value, and I think this will kind of help wrap up with what the infinite banking world is, right? So, because the whole thing with the infinite banking is, again, you're going to be able to borrow against the face amount, okay, which is your life insurance coverage, and that's not the case. You can only borrow against what's in the cash value, okay? So that being said, both of these, any life insurance that has a savings component has these, we like to call them the funny banking rules, right? And so the rules just off the bat, and mind you, this is all internal. You can find these in these policies. It's in the contracts. You know, is one, you have zero savings for the first 2 to 5 years. Okay. The worst I've seen is 10 years, right? And if you overfunded a lot, it could be a lot sooner. However, that goes back to what we were talking about, the ATM fee, right? So that's why there's no savings, because it all gets eaten up by what I call the ATM fee, what is called the surrender fee.
Right.
Okay. The other thing is that typically there's a lower rate of return or interest rate it's paying because it's being guaranteed by the insurance company. So they're not going to give you these crazy percentages, right? They're going to guarantee based off of an index, which will be very, very small. So it could vary, but let's say it could be anywhere from 2 to 4%, right? There's of course plus or minus 2 or 3, right? But that's usually the range. It's a very small range. The other thing too is that, and here's the part they also don't explain. So not only is there a fee to take out your money, like the ATM fee, but now when you take your money out, you can take it out as a form of a loan.
Right.
So what do you usually pay on a loan? What do you pay on a credit card? When you use your credit card, what do you have to pay? Interest. The interest.
The interest on it, yeah.
Right? So you know how they always tell you pay it off fast? para que no pague intereses, so you don't pay interest.
Yeah.
Okay, that's why. So in a cash value, you have what's called a
I was like, I don't know the numbers. All I know is how to manage it and keep it. Keep my score high.
Yeah, you're good.
That's
That's
all I need to know.
That's the huge. I was thinking interest, but I was like,
but see, but that's part of why we're doing this podcast, right? So that people can know what are the words to look for, right? And what happens is that when you have anything with a cash value, okay, this is specifically the cash value, and you're going to take money out, you have to take it out in the form of a loan, okay? And that loan will will charge you an annual interest, okay? So it's not monthly, but it is an annual interest. Now, anytime you take the loan out, the expectation with the loan is you have to pay it back, right?
right.
If you don't pay it back, they're like, don't worry about it. But what they end up doing is that they keep a tally. So when you do pass away, your family, let's say they had $100,000, but you took out a $10,000 loan plus interest. So now maybe they're only going to get out of the 100, whatever that difference was. Okay, so that's another part of it. So you have to pay to borrow your own money. Okay, and depending on which option you picked, there's an option that if you pass away, when you pass away, the money that was in the cash value goes to the insurance company, not to your family.
Right.
Now you can pay extra so that your family gets that part too, right? But those are all part of the rules of having a cash value, right? So now just breaking down the rules that way, I mean, would you ladies want to have that kind of investment or savings program?
No. It sounds like you can get a lot more bang for your buck just going ahead and putting it in an actual investment vehicle.
Yeah, and not even that, you get more bang for your buck just putting it under the mattress.
Right.
But yeah, so definitely with the investment vehicle, you want to make sure that that's something you can do too.
I've run into a client that had a policy, and her whole family had this policy. So it was 4 of them, and she really didn't want to, I guess, switch her policy over to ours just because of the fact that she needed to go. And I explained to her that, you know what, you're investing and all this, like the money, like I explained to her because, you know, obviously, like the way you were talking, like eventually it gets to like 0, 0, 0. So that all that money that you're investing is basically gone. So I explained that to her. She's like, oh, well, I'll just take it out then. And then so I was like, well, what's important to you? Is it the investments or is it the life insurance? She's like, well, I want the life insurance meanwhile, and then once that the policy is about to reach 0, I'm gonna take it out and keep what I'm having, what I basically saved from there before it goes to 0. The only thing is, like, people don't know this, is that there's another option to it. You can have that same life insurance coverage exactly with us, but also have so much more money invested if you were to have that, because that amount of time that she was having that whole policy, she only got maybe like 14,000, right? And I explained to her, I was like, with the time that you have left in your policy, if you were to invest it with us, it'd be like 124,000. And there's still people out there that just want to, like, that's kind of my important.
You know, and there's some people you're just never gonna be able to convince them because, like you said, they have either company loyalty or their agent has been really, really good and they built a really strong relationship. And I mean, at that point, there's nothing you can do. The only thing that I would do with a situation like that is when I look at the client and I go, look, who are you more loyal to? X company or your family?
Right.
It's asking the question. Sometimes it is getting into people's faces a little bit of like, well, who are you more loyal to? The company or your family? Right? And well, my family. Okay, well, I understand that you're loyal and I can appreciate that from you, but I want to show you an option that could be the best for your family. But at the end, it's your decision, you know? But let me show you what this could be for your family, right? And these are what the options look like. Or like, you know what, let's set up an appointment with the investment specialist so you can really see what that would look like, and then we can paint a whole picture. Or, you know, and it's just sitting down with clients and showing them, look, if that's what you really want, I can recreate that for you, but better.
Right.
You know, that's what it really comes down to. But yeah, so it all depends on what the client wants, but also just kind of showing them that. And again, that just comes from the re-education, the education of like, hey, let's kind of go over again what this really is for. Let's go over again. How does this work? How do different programs work? How do different savings programs work? How do different investment programs work? Right? How does compound interest work? And so I think that's what I love, and why I've been here, and why I'm so proud to be a regional vice president now, is that you can really sit and educate the client and show them what to do, and make sure that they don't get taken advantage of. I love this audience. Questions.
Do all terms work the same?
Okay. So no, not all terms work the same. One of the biggest differences in for simplest terms, yes, you pay this much, you're covered for this much, and it's level for X amount of years. Bottom line, most terms, right? Now, the biggest difference is that you want to see what's going to happen at the end, okay? Because some terms are going to say, well, I can renew it. Some terms say you have to show us again what your health is to make sure that you're going to live another 10, 20 years, right? So you have to requalify. So they don't have what's called guaranteed insurability, okay? So that's one of the things that people want to look for when they're looking at what specifically kind of terms they're getting. Another term that tends to come up, because I'm telling you, the insurance industry gets really creative. They created what's called the return of premium, okay? So what it is that it's a life insurance, that's a term, but it's said that at the end of said time, this is the money you get back, okay? Now, it's true, you say, okay, well, if at the end of that time frame, I'm going to get my money back or what I put into it, then I'm okay with that, right? Now, again, just like with anything, there's always conditions or rules, right? So for some people, it could be like, well, if you ever miss a payment or something, then you lose that benefit. Or, if XYZ doesn't happen, then you only get a certain percentage. Now, you have people say, like, oh, well, I'm always giving my payments. I'm never going to miss a payment. But have you ever had especially now, it's like, you have fraud, identity theft. How many people do we know of that say, my account got frozen for 30 days and they couldn't take out any payments? So if that happens, all of a sudden you lose your return of premium benefit, right? Or it could be like, hey, I changed bank accounts, or I forgot to update everything except for that one, right? Because I was at the computer, and then the kids made a mess, and then I forgot and I got logged out, and I never updated it.
Or something as recent as COVID and losing your job.
Or you lose your job, but then that would affect everything. So it doesn't matter what kind of life insurance you have at that point, because you're just struggling with all your bills anyway, at that point. So that's part of why we want to make sure we're addressing the client's needs and making sure that everything gets taken care of, but also in the event they have an emergency, they have somewhere to pull from. So that's where having a return of premium doesn't really benefit the client, because if at any point they need to draft for like an emergency, they don't have that, whereas with us they would. Yeah.
Well, you guys, this is such a very extensive conversation that we need to be having, because life insurance, it's a mystery to a lot of us, especially the younger generation, because we're not taught these things, right? We don't have these conversations, especially in our different communities. We really don't have these conversations. So that education aspect is so important to make sure that, one, that you're not taken advantage of, and two, that you can go ahead and do the best thing for you and your family, because it's not a one-size-fits-all, right? There's so many different things that can be done, but it all starts with you. It all starts with educating yourself. It all starts with taking that first step and understanding this is something that's very important, right? And this is something that we all need, because like Stephanie was saying, unfortunately, that time does come for all of us, right? So it's just really getting ahead of the game to make sure that when that time does come, what's gonna happen afterwards? What is that quality of life gonna be? So I'm so excited that we had you on the show today, Steph, right? She's a powerhouse, right?
And hey, if we need to do this as like a multi-session thing, I'd be more than happy to come back. We can do. There's so much information.
Definitely need
We need a lot more. Right?
So we'll call this one part one, because there's just It's just there's so much information. And mind you, it's like once you kind of get the basic outline of like this is what it is and this is how it works, it's so easy to build upon that and then to swap everything out. But it's really just laying down a foundation for people out there to understand how life insurance work, how does the industry work, demystifying all of these terms, and once you know what they are, it's really easy to get through.
Yeah, I agree.
Yeah. Right. Thanks you guys so much. I loved being here. It was a lot of fun.
Thank you for being here. And on that note, we will see you guys next time.
Subscribe.